Welcome to The Nest Show, the podcast that brings you insights into the crypto market, trading and investment experiences, and what we're looking forward to as we navigate this space together. Before we get started with the show, I want to thank our friends and sponsors over at Prime XPT, where many of our listeners have already signed up to trade by visiting the birbnest.com/PrimeXPT. Now, we're excited to reward you with a very special offer brought to you by our friends at Prime. Visit the announcement channel on our Discord to learn how you can receive a one-time trading bonus equal to 50% of your deposit amount. Exciting times indeed. Prime XPT is the most powerful trading platform offering immediate access to over 30 assets. Users may trade cryptocurrencies, forex, commodities, stock indices, and much more, all from a single Bitcoin settled account. Prime XPT gives experienced traders up to 100x leverage to multiply their capital while also providing users with multiple order types, low trading fees, and ultra-high liquidity to equip them with a one-of-a-kind trading experience. Registration does not require any user information, so visit the link below and start trading on Prime XPT in minutes. You'll be hearing much more about Prime XPT here and why we're so excited about the products they already offer, including a one-of-a-kind BTC and Ethereum options trading platform called Turbo, and an upcoming co-vesting product that will give traders and investors alike an entirely unique opportunity to multiply their capital. Much more on Prime XPT to come. But in the meantime, we want to thank all of our community and the Prime XPT team for making this partnership possible. Now for the show. Today is the second in our special two-part series for traders in which the founder of the Nest Club, Crypto Birb, shares the trading system he's fashioned over the years to build both his renown within the trading communities of social media, but also his considerable personal trading desk. In this series, Adrian defines his step-by-step trading structure that listeners will find to be pliable, repeatable, and profitable as they fine-tune their own trading architecture. In this second and final part, Adrian covers risk management and trade sizing, how to define Confluence and Confirmation, a summary from top to bottom, and then takes questions from his viewing audience. If you haven't already, we encourage you to review part 1 of this special two-part series of The Nest Show. Thank you for listening and enjoy the ride. What The Nest Show is. This is a podcast brought to you by the Birb Nest community, an independent crypto and forex-centered trading community built to sharpen each other in capturing opportunities in the markets while protecting capital along the way. What this is not, trading advice. We are not financial advisors, and you should not regard any information here or in the Nest Club as financial advice. You should always consult a licensed financial advisor before making any financial decisions.
Moving on to the next one. Okay, this is the risk management. This is the money and risk management. And I think it should come out as an obvious, but that every trade, every investment decision comes with a risk. Okay, and risk, again, we will need to define what the risk is. It is some form of a situation. Risk can bring you the opportunity and the danger. It's not only the danger. Out of risk, if the risk is well and managed well, it can bring you the opportunity to make money. So it is form of I should say the situation that involves some exposure to danger, but not necessarily the danger alone, but also to the opportunity. It often comes with statistical definition, with statistical, I would say, adaptation to the definition. Okay, that comes often with the probability and the likelihood of some events happening. So again, this is actually funny because it corresponds with a couple of funny things that there is such a theory that is against technical analysis that it's called a random walk hypothesis. Okay, and the random walk would assume that there are no trends in the market. Okay, that prices are completely random, that there is no actual, I would say, connection and bond between the prices alone. Okay, so a stock one day can cost like $1, right, per share. Then another day it can cost like $150. Okay. Then another day can cost like, 0.50, right, cents, for example, for a share. And that there's no trend, that the price movements are completely random. And these are the same people that would often, I would say, for the question of if you roll a dice, so what is the chance, what is the probability of having, this kind of like a roll dice, that just shows 1 point or 2 in the result, right? So, well, statistically speaking, it would be 1/6, right? There's only one situation out of 6 possibilities that fulfills the condition. For random walk hypothesis, guys, it would always be, I would say, 50%, because, well, either it points, either it shows 2, or it does not. So it completely obviously makes no sense, logically speaking. And and for this reason in general, right, we need to, because prices are volatile, because markets are volatile, they change and oscillate, okay, at times, and when they are less liquid, that it's easier to oscillate and move them, I would say, in certain directions more frequently than on other markets. Okay, the more capital the market brings, the more market capitalization it has, the harder it is to make a change, the harder it is to move this entire machine in the direction wanted. On the extreme opposite edge or end, okay, there's a shitcoin that is just completely liquid, that, well, anybody just can enter, right? And, well, it would just still build up the 50% candle growth, right, over one buy. So for wise money, for big investors, like Wall Street investors, like if you compare the Amazon, market cap, to the best of my memory, like, correct me if I'm wrong, but this was about like 1.15 trillion, right? While the Bitcoin capitalization itself is like 1/10 of that. So there's one stock in the entire market for crypto almost, right? Correlation. And for some big investor who's big, on the traditional markets, he would be even bigger for crypto. And the other way around, when somebody is not really, I would say, significant for the portfolio size, okay, in the traditional market, he can easily be whale on crypto. Well, this is why you need to apply a good risk management, and there are a couple of I would say, tips on how to do it. Right. First of all, you need to be aware of portfolio management, I would say, principles that also say to, well, allocate the risk between different asset classes. There are assets to your portfolio that are less and more volatile, and you want to consist and combine a portfolio that would consist and include like specific classes of these assets. Okay. And well, there's some early theory of portfolio management by Markowitz, okay, that says, well, you should technically have like 2 actual portfolios. One would be more like risk-free, the other one would be risk, I would say, not free, right? That would consist of not only the risk-free, currency or fiat, which obviously, in fact, we know it's not risk-free because there's inflation and hyperinflation often. But for for the risk not free, right, for the risk full, I would say, part of piece of portfolio, there should be a diversification between the assets that are high risk, low risk, and medium risk. Balancing such, I would say, portfolio allocation between these assets is what makes your portfolio grow heavily and faster if you're highly exposed to risk, because high risk means high reward, but also high loss. And well, if you prefer your portfolio to be more predictable and safer, right, over the time, you would invest more in I would say, low risk assets. Okay, stocks themselves, equities that come up with a yearly yield in a way for about 10 to 12% on average is already considered risky. And we are here talking and discussing cryptocurrency, so it's definitely way more risky than stocks themselves. So it's considered very risky by definition. So for a serious investor who I think like trades with serious size, and I mean like millions and millions, if not billions, right? So in general, you will need to have well, stability in your portfolio, okay? Because what you want to achieve is, well, for the portfolio to work and make profit for you, well, you can focus on other stuff. You don't need to be like a degenerate gambler trading on 1 minute candles. Like, if you've never done this, then imagine Warren Buffett sitting in his basement, okay, and trying to become rich in his early years by trading, 50 on 100 leverage, some penny stocks or some shit coins, or in general, this bad manner. Okay, in fact, the serious the more serious, I would say, your portfolio becomes, the size becomes, the more on the long-term run you're focused. Because the more money you have, you need to risk, well, proportionally less, because 10% loss on a trade for you will not mean anymore $100, but $100 million. Admit this makes it a huge fucking difference. So the more you grow, the less risk your portfolio should technically become. And this is this effect of scale, economically speaking, that makes it easy, or I should say easier, to make good money on the high, or should I say big size of your portfolio, right? Rather than small. And well, you can apply to that, the risk management rules or paradigms in a way, such as 2% risk per trade. So 2% risk per trade means, so for example, right, this is very, very, I would say, easy walkthrough. So what does it mean 2% risk per trade? It means that if your starting balance is, let's say, 10K, okay, it's $10,000, for example, and 2% risk, okay, and here means that, well, if you're going to fail, right? If you fail on your trade, you risk 2% of your balance, okay, which is 2% on your equity, right? So 2% against that, right, is $200, right? So whatever happens on 10K balance, right, you can maximally lose $200 in a way, right? Well, it is suggested on have highly volatile markets, and especially the lower the time frames you trade, right? The higher frequency trader you become, well, you should respect the risk more and take less risk, because if you think about it, then the more you trade, the more you lose. And I'm not talking about the ratio, the win rate, right? I'm talking about the actual number. The more you trade, the more you lose, right? If you take 100 trades, you're going to lose more than if you take 2 trades or 3. At the same time, knowing that, okay, then 2% risk, okay, on this one is $200. Well, you can actually calculate your position size, okay, and the position size itself, that calculator involves this 2% risk, okay, would be, well, the equity, okay, multiplied by the risk, okay, divided by the, well, stop loss, or should I say the distance in percent, okay, towards, well, being wrong in a way, right? So now let's say if your equity is here, right, the 10K, which we know on already, by the multiplying that, it would be already $200, but still putting on the risk, okay, which we know for risk is 2% over here, right? If we take the stop loss, that is, let's say, well, I don't know, like 8% from your current entry, technically derived from technical analysis, for example, right? Because, I don't know, you enter a trade, right, that is trending. It follows some symmetrical triangle, for example, consolidation, just the way it is on the Bitcoin right now, right? And it breaks out and breaks, retests the breakout, right? And it just follows through to the upside, confirming the uptrend, right? And you decide, for example, that, well, you entered here, right? But your stop loss technically, for example, should be placed over here at the pre-breakout swing in a way, right? If this is the breakout, then you search for the pre-breakout swing, okay, which was, for example, here, right? And this placing that below this swing gives you, for example, this 8% distance, okay, of loss potentially. So you go, obviously, and calculate it, right? Well, we know that this one kind of like crosses out, right? This one goes by 4. And what we have, okay, is 2.2500, right? So this is the maximum size of position that we can enter at this point in such a trade, so that if we fail, we lose no more than $200. It's as easy as that, right? And there are obviously different takes on that. Well, there can be as I say, the more short-term trader you become, the less risk you should be taking, because technically the more you lose, right? So then you go, over to 1%, for example. But if you are a long-term trader, right? Just for example, if you manage to get ever a look at the John Murphy's, financial markets of, technical analysis of financial markets, then for the commodities, as far as I can remember clearly, he would take up no more than 5% risk. Okay, then but 5% risk, well, it is more long-term, right? So you can afford losing more, but on one trade than on 10 trades. Just applying such a very strict, I would say simple, like rule, okay? This is what generates, some game of probabilities for you, okay? And lets you optimize your risk so that you simply don't lose more than you can afford to lose. Okay, so the good risk management, so the risk per trade, position size to that, and obviously the diversification of assets. Okay, so the portfolio management and money management aspects. So this is what makes it another point on the list. And to the best of my memory, again, correct me if I'm wrong, but I think we've so far got the actual understanding and self-awareness, which is the first point, the analysis, which is the second point, okay? The timing and the execution, that is the third point, right? The fourth point comes from risk management, okay? And the fifth point, okay, on the list, the fifth point is, what we call a confluence, right, or confirmation. Any trade that you are taking should have and include technical confluence. The confluence, which means that you would have many different indicators telling you the same thing, okay, and providing you with confirmation based on, theory. Because if you think about it, TA, technical analysis, is like our language code in a way, right? It's just the way we use language, like if I was talking Polish to you, if I was talking my own national, native language, okay, I'm quite sure majority of you will not really know what I'm talking about. Did this dude go fucking crazy? Like, what happened, right? And so on and so forth. But using the same code language, like in this very context, English, makes us understand and connect the dots on both sides, both me and you. And same works for TA. Technical analysis is also some set of rules and paradigms and, practices, okay, that, we as traders learn. And see, this is what makes it work. Some people say technical analysis, does not work, okay? Well, it obviously does not fucking work if you don't know how to use that. If you don't know how to summate, how to calculate, and then derive the equation mathematically, then no wonder it doesn't fucking work for you. So knowing this language, knowing this code, lets you understand the market, and you are clearly able to listen to what the market tells you. And it is represented, by a couple of ways to derive, the information from the market, be it, by the linear chart, okay, by the bar chart or HLC, or the candle chart, right? Or the hollow candles, or Renko or Heikin-Ashi, or raindrops, for example, by Transpider. I love them, right? So this, knowing how it all works, knowing this language and this code, lets you understand and act, put some rationality in that. Okay, so if you see a pattern, so actually just let's make sure to switch back to the screen sharing. Just an example, okay? The market is downtrending. Okay, the market is downtrending, which means it keeps making lower highs and lower lows. Okay, the supports keep being broken in general, right? But at one point it stops and reverses because the demand appears to be stronger than before. Okay, at certain level, because some certain level, price level, is more attractive for the buyers than other, right? And this is what makes it a support. So the market marks a swing, marks an upswing, okay, and a low, and then it makes the high and the downswing, okay? And then for the trend to start reversing, we need a higher low, which means that this low is the second low, the following low is higher than the first one. And the actual confirmation, okay, gauging on, after the down, after the Dow trend, right? The Dow theory for the trend, obviously. It needs a confirmation to close, to first of all break through the previous resistance and close above. Okay, close above, which means, well, it is often said that if a daily candle, which I often use myself, closes above certain level, it kind of like puts the confirmation, at least partially, to some certain level being reclaimed on smaller time frames. Because see, even if there is like some candle, right? If there is some candle looking like that, like a spinning top candle, for example. So if you, and this is on daily. So if you go and dive towards lower time frames, well, and imagine this is white, okay? This is bullish. So it means we open at one point. It will open here, okay? And we, well, at one point simply trade, right? This is the, well, kind of, I should say, the we can actually just apply some lines over here, right? So this is what makes it, I would say, the candle bottle limitations boundaries in a way, right? So it opens at one point over here. It opens at one point over here. And then it trades, okay? Trades, and at one point it breaks down, okay, towards the low, marks of the low, and still under the daily, after, like before the daily closes, it manages to reach out to the high, okay, to the high of the session, and still come back to close at this level, okay? This is the closing level. So this is how a daily candle on an intraday basis can look like, for example, right? So closing above certain resistance, let's imagine this was the resistance, right? Or this was the resistance, right? Here previously, like the high of some previous candle, right? So if it closes above on the daily, it truly means on the intraday basis, it, well, made a full oscillation and decided to close above with a strong upside bullish bias, right? And this is what makes it a confirmation. So search for a daily confirmation for your entries. And so we need to close and reclaim this resistance in here, right? And what does it mean for the reclaim? Well, it does mean closing the high time frame candle above certain resistance, okay? Just the way it is, for example, here, right? If we close such a strong candle above the resistance on the, for example, weekly, right? So if this is, for example, like, well, a daily time frame, then you want to see a close on the weekly, okay, above certain resistance. And this is what brings you the confirmation that the resistance was broken and reclaimed on the smaller time frame, on the lower time frame, okay? That's for the reasons that I brought and mentioned over here. So again, until we make a new high over here, okay, and best if we reclaim it, which means, well, on the intraday or intra-week in such very context, okay, basis, we make a breakout and retest and reclaim this, make a new support out of the previous resistance. This is what truly means a reclaim, right? So this is a sequence of breakout and retest on lower time frame that creates a reclaim, okay, that can be easily visible on the weekly chart in this very context, by the closing through some certain resistance. So having the reclaim, okay, is another is a point for the confirmation and confluence. And when you actually, I would say, want to enter the best trade, okay, you need to search also, well, best for some patterns, okay? If there is some chart pattern, like you go to to a chart, right? The market is downtrending, for example, right? And there is some pattern, right, that is called like a double bottom, let's call it, right? With this resistance kind of like neckline, quote unquote, right? And we haven't marked out the breakout, then okay, based on your code language that you got to learn, that all the people trading should technically know or at least be aware of. Okay, that well, it's safer to long or to enter a trade for buy on the breakout retest. Okay, because especially in highly volatile markets like cryptocurrency, it's very easy to manipulate the market. Okay, and well, because the smaller portfolio coming from traditional markets is not so small anymore on crypto and has much more to say. Okay, on the market direction, especially if you put some derivatives on like CFDs or futures, right, on leverage. So it's so easy to manipulate that. And the reason for manipulation on the market is, well, the whales. And it's not a fucking conspiracy theory, okay? Whales do exist, and there are some people who have more money, and it's fucking natural, okay? It's natural that you would have fewer shares than Jeff Bezos of Amazon, right? In general. For your big position, you need the liquidity. You need counter liquidity side and party to fill your order. So if you want to sell 100 shares, for example, right, of Google Alphabet or Amazon, then you need to find somebody to buy that 100 shares for you or from you. If you wanted to sell and dump, $100 million bag on someone, okay, you either need to market sell that, okay, and just sell for no matter the price with large slippage and set your order so that it just simply dumps the market until it completely fills the position, the sell order, or you need to wait for the liquidity itself with limit orders, okay, to come up and appear. So the market mechanism, in a way, for the order, I would say, all the books, right, and the order blocks for how it works in general, right, for how the liquidity works, liquidity engines work on exchanges. And when you don't really have enough liquidity, you need to trap people and make them believe it's following the certain direction. Here is a technical breakout. Whales know the code, the language well, okay, and they want you to believe. They want you to believe because, well, these are the market makers, okay. The participation, like any trend, consists of the accumulation, the participation, and distribution. Or if it's the downtrend, it's the distribution, participation, and accumulation that makes it a full round cycle. Well, the participation comes from the street, from the people buying that and following, or just simply selling on FUD. But the extremes, the market pivots, the breakouts, okay, that are often called specialist breakouts, after the CMT kind of like, I would say, nomenclature in a way. They want you to see and trigger your buy entries because of the breakout of such an order, right? The breakout of such a resistance. And knowing that everybody would be buying that because, well, the code is telling you that it's bullish, okay? They have the opportunity to sell at a large bag, okay, in a compressed buying, like a zone buying layer. Everybody is buying here. So they can sell and realize their profits because, for example, they got somewhere around the bottom because it's the whales that reverse the market, okay? Well, because it's up to them to decide, okay? They have lots more to say than an average trader, retail trader. And they can use this compressed liquidity, okay, to dump at a tiny slippage. Other than that, they would need to dump the market, okay, all the way down. Well, and it would not make any fucking sense whatsoever anymore because, well, they would just come back to the place they came from. So it doesn't make sense too much. So they want to trap you. They want to trap you. And this is the way, the kind of like whales would think. Okay, they want to trap you to get the liquidity. And but again, that especially comes on lower time frames. Okay. And this often comes only from individual whales, the retail whales in a way, right? Somebody who has just simply like an individual who has more money than others. But apart from that, you also have institutional whales that are hedge funds like investment banks and so on and so forth. But you don't expect them to play fucking degenerate leverage on 1 minute chart, right? You shouldn't be expecting that at least. The more indecisive the market is, okay, the more chances they're going to trap you. So the easiest way is just simply not trade from trading consolidation, but just wait for a trend. So another point, okay, another point apart from confirmation coming from the breakdown retest is playing the trend and following the trend. There is a reason there exists such a saying that trend is your friend. And when you kind of like short, or I should say buy against the downtrend, okay, it's like you're swimming up the river stream, right? You're not going to make it. You can try to, just swim against the river stream like 1 minute or two, but sooner or later you get like, so exhausted that you're not going to be able to continue that. And this, you're not going to, unless you're a whale, you're not able to stop the market, okay, and reverse it. And any second of your life, you should not believe that for your illogical understanding of how markets work. Okay, if you don't have large share of the market, it's not you that makes the market or reverses that. Okay, so you need to play the game of whales and decide what they are going to do. Okay, and what majority of traders would do. So for this reason, okay, the another point as well, following the trend. Okay, so follow the trend. Wait for confirmation often on a high time frame basis. Okay, if it's daily close or if it's weekly close, if you're playing some larger time frames. Other than that, definitely suggested to spot patterns. Okay, if you see some code, okay, in the language, the formulas, the patterns, okay, I've already explained that a couple of times for why chart patterns exist, and they do exist because we make them exist. Okay, because our brains are rewarded for recognizing some patterns and formulas that we met in the past. Okay, so whenever we see something we learned the other day, our brain gets rewarded with dopamine hormone that kind of like gets easily addictive for us. So for the same reason that chart patterns exist, the superstitions exist, like black cat crossing a road and so on. So we know that patterns exist and we know that they work. Okay, and the only thing is not to fall for the trap. That is the reason for why you don't really safely enter the breakout, but wait for the retest instead. Okay, so if there is this, for example, uptrend, right? Some consolidation, like a pennant, the half mast formation, right? The measuring move applies to the same distance, right, of a pole, and so on and so forth. Then it trends, right, and it follows some, for example, like head and shoulders, right? So any pattern is a form of consolidation. It's a form of sideways movement. It's not a downtrend. It's not an uptrend. It's a sideways movement. Okay, and any sideways movement comes from market consolidating, which is taking profits or accumulating. Okay, the distribution of profits or accumulation of position of a given asset. And as any pattern is a consolidation, is a sideways movement. It is kind of like brought and derived with the range, the range high and the range low, and also the kind of like 50% mid-range that comes and lets you know the bias, right? If we are bullish side, we're above, right? And if we're below, we're on the bearish side of the range in a way, right? But it's still the breakdown and retest of this head and shoulders formation that should kind of like bother you to enter a trend, right? Because I've seen hundreds, right, of early head and shoulders patterns like that pretty much like traders knew that if asset is still undervalued on the long term, it's still strong per trend, like just the way it's happening for Bitcoin right now. When I say, when I keep repeating every time that the trend is still up and strong on the weekly with no signs of exhaustion, we should technically assume that, strong supports are generally stronger than resistances. And they're likely going to hold, right? To be held more than not. Then it can easily everybody would be shorting that early, just for the sake of optimizing and maximizing the profits, right? But it's impossible. It's impossible, I should say, to move the market unless you're a whale, and everybody retail, okay, would be trying to short that. And again, you have the compressed liquidity layer, okay? That is when you actually just decide to trigger the cheap locally, asset, right? You are just simply buying a large stack, okay, because of compressed liquidity. And this is, what makes the pattern, what makes the head and shoulders fail very often, or fail to the downside. But at the same time, this is the reason that any pattern can work as a reversal and or continuation. And when the trend is strong, you should technically always assume consolidation before a continuation. So again, patterns. Okay, we have the reclaim, the breakout reclaim, the confirmation. Okay, the whale game and the pattern. So on top of that, you also have the confluence between different indicators. Okay, so if we move on to, for example, like a Bitcoin chart, this Birb indicator, this very opportunity context, right? Whatever. And then Birb indicator itself is a complex one. Okay, it consists of a couple of indicators, momentum derived. But if you think about it, okay, you want to see a confluence between trading signals. So I'm not even talking about the confluence on different indicators, which is obviously good if MACD, moving average convergence and divergence, shows you the same, that shows you, the stock RSI or RSI itself, or, the Birb indicator, or, accumulation distribution like indicator, and so on and so forth, or volume itself, or volume weighted average price, right? Any entry is much safer when there is a confluence of signals. So which means if you want to enter a good trade, you want to see the closing above certain level. Okay, if there is some, you could call that like a rounded bottom or whatever over here, right? But in fact, it's local bottom. It's not like a bottom over here, right? But if you were, I would say, like serious about it, about any trade that you take, okay, then you would truly want to enter a trade only when it's confirmed to close above certain resistance. Just for example, it closed over here, right? So that you can put some more certainty to your probability game, right? So again, you have the resistance, the highest point locally, okay, that was broken and reclaimed, which means on intraday, on the lower time frame, okay, it got closed above, which means there was some oscillation that closed above the resistance, okay? And if it often comes with a buy signal from an indicator, okay, here or just here or somewhere else, right? You spot some for some divergences, okay? Just for an example, you spot for some divergences of hidden divergences or the regular divergences. Okay, so when the prices keeps making lower highs, for example, and low lows, but in the downtrend it's lows that count more for the oscillator. Okay, and the oscillator at the same time keeps making higher lows, okay, then this is a classical bullish divergence. And the opposite edge is when the market keeps making new highs, okay, but it's diverging and making new lower lows, lower highs on the oscillator, okay. This is what shows a bearish weakness. I should say bullish weakness, the weakness of bulls, but bearishness. And so you want to enter a trade, you want to see a signal on the indicator, and you want to see breakout and reclaim of a certain level above the resistance. And you also want to see an indication. You want to see an indication and signal printed by your indicator, okay? And when you combine all of them along with a chart pattern, okay, and along with risk management, with time management over here, with full complete analysis, knowing just 48 that this is technically undervalued, or fundamentally just that it's kind of like safe, that it has any fundamental potential, right? Now, and the sentiment is, for example, aligning well, and the intermarket analysis just works well as well, and you are aware of what you are doing. And when you are aware of what you are doing, with the self-awareness, with understanding and defining, being able to define whatever you're dealing with, starting always with the very first word, just as your takeaway, right? Just think of the best first word always that corresponds and describes best whatever you are asked to define. So when you sum it up all, this is what you're going to get. You're going to get a perfect entry for a perfect trade. Right? And this is for the entry, but it also works for the exit, but the other way around. Okay. So when you enter the long and you see that sentiment as well, extremely greedy, okay, then the intermarket shows you that the capital should technically outflow from the market. Again, because to follow to more stable or steady or some certain, environment. Because of the crisis, for example, right? And the fundamentals are already telling you that, well, company is not producing no revenue, no earnings, but the price keeps growing. Okay, so price to earnings ratio, for example, P&E, just shows you in a way that the trade is not sustainable anymore. And then this is, well, when this is aligned with, I should say, with the good indication from, for example, bearish divergence on indicator, this is what makes a perfect exit. And you just see and spot for key resistance, okay, that you want to sell, because you need to sell before the resistance occurs, okay. And if there is, just see, if there is a strong resistance somewhere, if there is a strong resistance, for example, on a daily chart, if there is a strong resistance over here, right, because we know the market kind of like, was unable to break out above 10.5 at certain point, right? And you know that there was a certain level that was key support, that it used to be key support over here, right? That once broken, well, it never truly let us close above this level before, like except for this candle. Then then you can tell you have some strong support. So it's no wonder, okay, that the market is consolidating under the resistance. But when the trend is strong on the weekly time frame, okay, when the trend is strong on the weekly time frame and you see consolidation under the resistance, well, it's bullish. It's most usually bullish, okay? And this is the reason for me to believe that we are still about to make new highs. Again, so you want to have a good entry, a confirmed entry, for example, over here, right? You got the resistance, the market, swang down over here. So you could see, for example, there is an MA, 50 support over here, right? It just goes up, breaks up the level and closes above. Okay, then the close above is the signal for you to enter. And when it comes up with a technical indication over here for a buy signal, okay, and the actual trend strength, and this comes with, as I said, price level confirmed, then this is, you're going to, for example, open a long position, right, at this level and decide to set a stop loss below some key last swing, okay, and you want to take profit before the resistance hits, right, and that's it, and that's what the triangle here means, right? That's what the triangle means. So the execution and exiting the trade below the resistance at the confluence of indications, okay, especially when it's searching for some divergences as oscillators. This is what makes a perfect exit, and both merged, the perfect entry and the perfect exit, when combined and met all of these conditions we've today discussed, well, there is no way technically you lose on the long term. And that's what I wanted, guys, to tell you about right now with regard to what makes a perfect trade. I'm opening a Q&A session for you, right? So I'll give a second and let's come up with some questions so that I can answer them quickly, briefly. And by the way, let me know in the comments if you consider this, webinar today to be valuable for you. There are a couple of questions, okay? So current, starting from Ozzy, current Bitcoin update on 15-minute. So see, 15-minute chart. I was analyzing the 15-minute chart, to be fair. Okay, so we got the resistance that was reclaimed, broken over here. Right? This was the breakout reclaim on smaller time frame, but in fact, the breakout retest always looks the same, no matter the time frame. It is because if you want to trade the breakout retest on the time frame that you're seeing, okay, then it always looks the same and actually just needs well, the same, I would say, outlook, right? It looks that there is some resistance, there is some consolidation perhaps, right? You see the breakout, and then you see the breakout retest, okay? And it always looks the same. It looks the same on 15-minute chart, on daily chart, on weekly chart, and so on and so forth. But the time that it takes to develop this way, it's proportionally larger, right? So if you're a high time frame trader, you would trade the same way and wait for the breakout retest on the high time frame, right? Just the way you would do on the smaller time frames, with all the points that I kind of like mentioned today discounted, right? So again, here's the resistance. So it technically should slightly throw it back, okay, towards this area to retest it on this time frame. Okay, so this would make a good long entry in my opinion, especially that you would have until then the support from a maze. Okay, and well, this entire sideways movement. Okay, this entire sideways movement is definitely, if you were to calculate, the 50% mid range over here, right? Then what you would see is that key level, okay, would also be coming from the, I would say, pre-breakout area over here, right? Merged with most likely MA 200. So for now, trend is definitely strong up on the higher time frame. Lower time frame, I would expect this one to throw back, okay, towards at least 9300 low. Another question: is 9400 current support resistance on Bitcoin? Well, it's more obviously more for the resistance. If it depending on what the price is, this is what makes it a support or resistance. If the price is above a certain level, that this should act as a support, right? And if the price is below a certain level, this is going to be a resistance. So if the price is trending above 94, then this is a support. Could you one day do a tutorial webinar about the Birb indicator? Of course, Alessandro, I'm going to do that. Thank you so much. Yeah, thank you too for attending. And well, just to kind of like remind you, right? See, there is this blog section. Okay, there is this blog section that also brings the actual updates from the market, right? So any market report that comes, you're from now on able to read it on our website. Okay, that lets you, I believe, read it in a more constructed manner, in a better order, visibly, than Discord itself, right? So I completely encourage you to go to the birbnest.com and blog, okay, apart from other articles that you can find there. And well, don't forget about our newsletter, okay? Don't forget about a newsletter. It's free. We changed it from the monthly bulletin to the weekly newsletter, and the next one is coming next Tuesday. And well, it's free. It's just delivered on a silver plate. Okay, don't forget about the infographics too. If you want, well, if you don't really want to pay anything for that, it's completely free, right? So you go to infographics and study what we put in there, right? Our team efforts, like 14 people in the team. It just all created, we all take and commit the time for you to create, well, to use that, right? And it's just so much knowledge in here that you can get. Not to mention the podcast itself, okay? Not to mention the podcast itself. Like, what I am just giving to you at the silver plate is classically like legit edge, okay? That you can go and just learn, I swear to God, for free, right? It's just there. It's just there. And well, and what I wanted to remind you, okay? And this is going to be obviously, I should say, very important, not even for Wider Nest, but we have, especially to those who are new, right, or to those who are on trial, remember, okay, there is this free 7 days trial that is having no commitments, and you can just cancel that at any time. And I hope you enjoyed this scrolling tape, right? I was very like stubborn to have it on top. And that's it, guys. That's it. I thank you all for participating today in today's webinar. I really hope it brought a lot of value to you, and I highly encourage you to rewatch it. Right, I highly encourage you to go and sign and actually just write down all the points that we've been mentioning, that I've been talking about. Because, well, if you want to know what makes a perfect trade, well, I've already just said that. But for the long-term position for Bitcoin, okay. Well, long-term entry for Bitcoin was around below 5K. There is no doubt about it. Okay, so long-term, I don't think this is the safest entry. It doesn't mean it cannot be profitable, but long-term entry, okay, long-term entry was around 5K, below 5K. This is what was undervalued by the market, okay, and below the mining costs. So the closer to that, definitely, right, the better. And I would not definitely encourage to enter with its full size, but just ladder down, okay, and compound on the direction, right? But still, trend is up, so most likely still going to make it money in the long-term run. That's it, guys. That's it. I appreciate your time. I'm very honored. I'm very happy and very proud of all you guys attending this today's webinar. That's it. It was Crypto Birb speaking, and on to the next one. Trade safe.
I'd like to thank our listeners for joining this episode of The Nest Show. We invite you to connect with our guest on Twitter, where Adrian is @CryptoBirb and I am @BenjaminT1717. Again, we want to thank our sponsors at Prime XBT for their support of the show and for their support of our listeners. Once again, after signing up to trade at thebirbnest.com/PrimeXBT, be sure to follow up on the announcement channel of our Discord and learn how to capitalize on their generous trading bonus offer that they've exclusively made available to our community. If you've appreciated the depth and breadth of what you've heard with us today, subscribe to our podcast and find our landing page at thebirbnest.com. We have a vibrant Discord community which acts as our central hub of operations, and we welcome you to join us at thebirbnest.com/Discord. We also offer an extensive free bulletin on emerging crypto market trends, exclusive undervalued gem reports, and in-depth expert technical and fundamental analysis at thebirbnest.com/bulletin. We always appreciate engagement from our community, which of course means liking the video and subscribing to our page, where we insist on bringing you the highest quality content available. Also, we're happy to incorporate tips and topics from our listeners and encourage you to email us at thenestshow@thebirbnest.com. This podcast is brought to you by the Birb Nest. Thank you, and trade on.